This slide shows a brief profile of the company. PABC is the pioneer in manufacturing of aluminium beverage cans in Pakistan. It started production in September 2017, and presently our rated capacity is 1,200 million cans per year. The company is currently undertaking an equalization and debottlenecking project that will not only improve efficiencies but also enhance rated capacity to 1,300 million cans per year. Operating from Faisalabad, PABC focuses on sustainable and ethical business practices and aims to be the preferred choice for beverage can solutions. This slide shows PABC's corporate information. PABC was incorporated on December 14, 2014, and listed on Pakistan Stock Exchange on July 16, 2021. The authorized share capital is 4,000 million, with paid-up capital of 3,611 million. Kristen Heather BMG & Co.'s chartered accountants serve as auditors, and THK Associates Private Limited is the share registrar. The company's registered office and production facilities are located at M3 Industrial City, Faisalabad. The board of directors include chairman, CEO, 2 independent directors, 3 non-executive directors, and that includes 1 female director. Mr. Asad Zaidi, Chief Financial Officer, will now brief the participants on company's performance, risks, and strategy. Mr. Asad.
Thank you, Sohail. Dear analysts and investors, good afternoon. Now we are presenting the brief review on company's financial performance, future outlook, and key risks. In 2024, net sales reached PKR 23.07 billion, marking a 16.88% increase from last year, PKR 19.74 billion. This is our highest ever sales figure, driven largely by exceptional export growth. Sales have more than tripled since 2021, reflecting a consistent upward trend as we scale operations and expand market reach. Exports revenue grew significantly to PKR 14.45 billion, up 53.3% from PKR 9.43 billion last year. This jump underscores the shift in our sales mix towards international market. Exports now make up 62.6% of total revenue, as compared to 47.8% in 2023 and 18.3% in 2021. Strategic focus on high volume exports orders contributed to this surge. Local revenue, on the other hand, declined by 16.47% to PKR 8.61 billion from PKR 10.31 billion last year. This drop was mainly due to the inflationary pressures and, to a lesser extent, subdued consumer sentiment linked to the Gaza conflict. Gross profit rose to 10.24% to PKR 8.43 billion, up from PKR 7.65 billion last year, in line with the revenue. Net profit for the year came in at PKR 6.10 billion, a 21.65% increase over 2023's PKR 5.02 billion. This was driven by a strong operational performance, improved other income, and favorable exchange rate movements. As compared to 2021, profits has grown nearly 4 times, reflecting the company's strength fundamentals. EBITDA jumped 31.6% to PKR 8.34 billion, up from PKR 6.34 billion. This shows that even after adjusting for depreciation and other non-cash items, core operational performance remained robust. It's worth noting that EBITDA has grown 4-fold since 2021. The GP ratio declined slightly to 36.53% from 38.41% last year. This was primarily due to the higher fixed charges like depreciation and increase in the variable overheads, for example, utilities, salaries, fuel, and all in line with the higher volumes and expanded capacity. Despite margin pressure at the gross level, the net profit ratio improved to 26.46% from 25.42% in 2023. This reflects strong cost control, improved investment income, and better FX management. NP ratio is now at the highest in 4 years. Earning per share rose to PKR 16.90 billion from PKR 13.90 in 2023. A 21.58% increase. This shows the direct benefit to shareholders from improved profitability. Earning per share has grown nearly 4 times since 2021, which speaks to the strength and consistency of our earning growth. Total assets increased by 47.8% to PKR 31.71 billion, up from PKR 21.46 billion last year. This reflects continued investment into operational growth, a growing investment portfolio, and expansion of export-driven receivables. Shareholders' equity rose by 57.3% to PKR 16.74 billion, up from PKR 10.64 billion in 2023. The increase was driven by strong retained earnings and disciplined fund management. Equity has more than tripled since 2021, highlighting long-term value creation. Next slide. So this slide presents a graphical depiction of our financial performance. The visuals reinforce key trends already detailed in earlier slide, highlighting consistent sales growth, strong earnings, healthy profit margins, and the positive impact of our export-driven strategy and operational discipline. In 2024, we successfully completed a major capacity enhancement project, increasing our rated capacity to 1.2 billion cans annually. Installed capacity was also scaled up to 1.05 billion cans, a 23% increase from the previous year, enabling us to meet growing global demand. Despite the expansion, we maintained strong operational discipline, with actual production reaching 936 million cans, reflecting a robust 15 years over last year. Utilization settled at a healthy 89%, slightly lower than 2023 due to the ramp-up of new capacity commission during the year. The capacity enhancement not only supports future growth, but also strengthens our position as a key supplier in the international beverage can market. Talking about capacity expansion, we are moving forward with another round of capacity expansion, taking our rated production capacity from 1.2 billion to 1.3 billion scans per annum. This project is expected to come online within the next 3 to 6 months. The benefit of this expansion go beyond volume. Through debottling and enhanced line alignment, we aim to unlock greater operational efficiency and reduce per unit production cost. Financial outlook. Looking ahead to for the year 2025, we are projecting revenues of approximately PKR 22 billion, supported by an expected sales volume of around 890 million cans. This conservative estimate factors in the current economic environment, including foreign exchange volatility, inflationary pressures, fluctuation in domestic demands, and border closure issue with the neighboring country. Now we're talking about risk and uncertainties. As we look ahead, we are aware of a few key challenges: macroeconomic uncertainty, like rising inflation or interest rates, could raise our cost and impact demand. Foreign exchange shortages and rupee volatility may also increase input costs and disrupt imports. Regional tensions at the Afghan border and geopolitical issues like the Gaza conflict affect both logistic and consumer sentiment. On the industry side, Aluminium prices are rising and new competition from Central Asia may put pressure on our margins. Changes in tax policies or cess on exports could also affect our growth. Having said that, we are actively managing the risks by staying flexible, expanding our export base, and closely tracking market development. We are using our experience and skill to stay resilient and in a shifting environment. Thank you.
The presenters will now take your questions. We are opening the chat boards. Please state your name and organization along with the question.
Sorry?
मेरे पास नहीं आ रहा chat.
It will start from financial year 2027. The second question is? हम सबको ये visible हो?
Mr. Zain, can you view the questions posted on the chat board?
Ahmed sir, can I unmute it? Please unmute.
आप unmute करिए.
Yeah, I can hear them. I can read them. I was also muted.
No, it's okay.
Yes, sir, please. The question is, what if our exports decline due to Kazakhstan's Central Asia plant? That will be, what will be our profit if we stock to Pakistan local production for next 3 to 5 years?
This would have to, we would have to run a complete budget exercise for this, and there's multiple factors that it depends on. It depends on how we expect local demand. Do we expect the Kazakhstan plant? Does it impact any of our Afghanistan sales? And if we are able to make up for this volume from any other market. Otherwise, I think our Central Asia volume is, Sohail, you can tell the exact amount. But there would be an impact, of course, on our profits. I think it's almost 100 million cans. But, you know, there are too many factors to just give an estimate like this.
The next question is, sir, can you please share whether the company is completely fulfilled local in Pakistan demand for aluminium cans, or is there any room for more demand?
We are fulfilling majority of the demand. Uh, we're fulfilling all the demand for the sizes we make for the 250, 300, and 330. There's some demand for 500 ml cans that we don't produce.
Okay. Sayed Hassan Raza has asked with the talk of reducing and capping import duties, including phasing out additional custom duties and and regulatory duty. What impact do you foresee on PABC's business? Would this lead to increased competition for imported cans or changes in your input costs?
This will definitely lead to increased competition from imported cans, um, and it's not going to impact our costs. So this would have a negative impact on PABC's earnings.
Okay. Uh, why company is going for another expansion while current capacity is underutilized?
Our business is seasonal. For 8 months of the year, roughly, we have a lot of business, 8 to 9 months, and for October to Jan, it's a much slower season. So that's why our capacity utilization, if we had orders for the full year, we'd be able to utilize it, but we believe we should be able to utilize this additional capacity enhancement uh, during the high season, or even during even a few months of the high season. It'll be paid off in a few years. But more importantly, we want to make sure that we can comfortably meet the demands of our customers, because for many of our customers, we're the only supplier, and that's an important strategic position. And this expansion we could do again through certain debottlenecking. So that's why we are doing this expansion.
What will for domestic sales? What CAGR rate do you foresee for the next 5 years?
Um,
Uh, shall I repeat the question, sir?
yeah, I'm just trying to see where that question is. Uh,
For domestic sales, what CAGR growth rate do you foresee for the next 5 years?
We are asking about demand of local in next 5 years.
if we see, actually, in the last 2 years, demand has fallen, and that was because of the high inflation as well as the Gaza conflict. So domestic demand has come down in the last 2 years, but in the next 5 years, I would expect it to go up, with the economy stabilizing, and inflation coming down so sharply. That should help. And the other factor of customers shifting away from Coke and Pepsi towards local brands. Many of the local brands have in this past year tried launching in cans, and we have facilitated them. So these two factors, I think we should have a 10 to 15% CAGR for the next 5 years.
Okay, the next question is please specify the reason for expected lower cans in next year despite new capacity coming in online in 3 to 6 months, as you told. Please share the average price of the can. Uh,
And
I think
cost
this
per
question
can,
is
what are the
about
export margins?
maybe
So our pricing depends, with our each customer to customer, it varies, and market to market, it varies. And it depends on many commercial terms with the customer, as well as certain specifications they have. So it's something that we cannot be shared in a public forum. That's something that would impact our business if it's shared. But the reason for lower cans in the next year, expected lower cans, is the new plants coming on in the region, in particular the new plant in Uzbekistan and Kazakhstan. So we expect that business to be impacted.
Okay, the next Question is the short-term investment.
We have a short-term
Short-term
investment.
Yeah,
investment.
so is PABC looking for avenues to use this capital? Yes, we are actively looking for avenues to use this capital and also to invest it to earn a good return for the shareholders.
Can you please comment on the SEZ tax holiday but tax on export income under normal tax regime?
Yeah, we are fully exempted till 2026. I had already answered.
What percentage of cost of goods sold is attributed to aluminium as raw material?
Is this there in our financials, Sohail?
They are asking about it's a 65% of our total CGS.
They're asking how
Just
much
for
is the
to give you a
aluminium
example.
is in the reported into the aluminium component in the raw materials that we. Do you pass on for higher costs to your customers in inflationary environment, or do you retain the impact? How sensitive is it to increase in price?
So the only mechanism for pass through to our customers is the changes in aluminum pricing. But with some customers, there's annual contracts, and with some there is inflationary pass through on an annual basis, which have a longer term contract. So depending on how our costs are impacted and how the costs of our competitors are also impacted, there's a willingness um, to take up price increase by our customers. And if our costs are not impacted so much, especially something that impacts us and not our competitors, then it's harder for us to pass on any cost increases.
Okay.
Company has surplus cash. What actions are you planning to take with it? We are investing it, and as the company has a tax holiday, we believe that that's best for the shareholders.
What are next is what are your outlook on margins going forward?
I expect margins to be under pressure.
How difficult would it be for a new aluminium can company to start operations in Pakistan?
I think it would be completely unviable with just 30% of our capacity. We can, or 35%, we can meet the entire demand of the country, and we have a completely deleveraged plant set up at when the dollar was 106. So they would be completely cost uncompetitive compared to us.
How much it will cost to set up a new can plant on average?
With the capacity that we have right now, $120 million.
I think that's it. What's the percentage amount of sales tax?
It's 18%.
18%. Sales outlook on sales, especially post boycott. I think they are referring to we have already addressed that. The dividend outlook, I think this question has already been addressed. Dividend outlook, sir.
It depends on the board.
Yeah.
Whatever is the board decision. I can't comment.
I think that's it.
Right now, there are no more questions on the board. There's one. Has the boycott affected the have the boycott effects bottomed out? I think they're asking has the impact
It's
subsided?
difficult to say. I can't say the bottom of the boycott.
How much has the border closure with Afghanistan affected gross margins?
It doesn't. It's difficult to say exactly gross margin, but it's affecting sales. We're losing out on sales because even though we have orders, we're unable to deliver, and customers who are either losing out on sales or looking for alternate suppliers. So both in the short term as well as the long term, it's impacting our company very significantly because in the last 2 years, it has been constantly opening and then closing again within a few months.
Okay, I think that's all questions have been answered, sir. No more questions on the board. I will thank the participants and the directors for attending the meeting. Thank you very much.
Thank you.